Long-term mortgage rates in the United States rose in December 2024 and exceeded the level of the end of the year before last 2023, reported with reference to the largest U.S. mortgage agency, Freddie Mac. According to the government mortgage corporation Freddie Mac, the average rate on 30-year loans in the last week of the year was 6.85% per annum, compared to 6.72% a week earlier. At the same time, it was at 6.61% in 2023. In turn, 15-year loans are now provided at an average of 6% per annum against 5.92% a week earlier and 5.93% a year ago. As you know, Freddie Mac calculates average rates based on data from about 80 organizations that provide mortgage loans across the country. The rates do not take into account potential fees and other fees associated with mortgages. Traditionally, the cost of mortgage loans with a small lag follows the dynamics of yields on U.S. government bonds, which in turn is sensitive to changes in the forecast for the prime rate of the Federal Reserve. Freddie Mac chief economist Sam Cotter noted that mortgage rates rose, recovering from some declines. While the slight improvement in home sales in the primary and secondary markets is encouraging, but the market is still suffering from a monstrous housing shortage. As of October 2024, the average U.S. mortgage reached a record high of $409,942. The MBA Mortgage Lending Index showed a 5.4% increase in December 2024, indicating increased activity in the mortgage lending market. This indicates a steady demand for mortgage loans despite fluctuating interest rates and economic conditions. I offer you a brief historical tour of the mortgage. A mortgage, as a banking instrument, is a long-term loan for the purchase of real estate, where the real estate itself serves as collateral for the loan. Historically, mortgages originated in ancient Greece and Rome, where borrowers pledged their land plots as collateral in case they were unable to repay the debt. But the concept of mortgage as a debt obligation with the right to pledge real estate with certain conditions became widely used only in medieval Europe. The first mortgage system in its modern form appeared in Great Britain in the 16th to the 7th centuries. At that time, borrowing money to buy land became essential for the growing economy and the establishment of a class of owners. Mortgages at that time were not available to the general public, but rather served aristocrats and wealthy merchants. Interestingly, it was in Britain that the first mortgage banks such as Halifax and Lloyds Bank began to appear in the early 20th century, making mortgages a mass product. With the development of the banking system in the 19th and 20th centuries, mortgage lending became crucial to the economy. The reason for this was to stimulate the demand for housing among the general public, which helped to increase investment in the construction sector. Countries such as the UK and the US improved mortgage schemes every year, making them affordable to the middle class. Subsidized government programs became the most important element in the formation of mortgage as a mass banking product. In the United States, the mortgage lending system received an impetus in the late 19th century, but the main stage of its formation was the 20th century. The Great Depression of the 1930s was the catalyst for the creation of such institutions as the Federal Housing Administration, FHA, and the Federal National Mortgage Association, Fannie Mae, which laid the foundations of the modern mortgage system. In the United States, the Federal Housing Administration, FHA, began to support mortgage lending to the broader population, which led to an increase in home purchases and stimulated the economy. Banks began lending on a large scale, which provided a steady stream of income and allowed for faster urbanization. Mortgage lending in different countries of the world has its own peculiarities, which is explained by differences in the economic situation, government policy and legislation, income level and culture of the population. The U.S. mortgage system is unique for its long-term fixed rates, which allows borrowers not to worry about future rate increases. However, the U.S. mortgage market is also highly dependent on government support programs and global financial markets. Mortgages in China are relatively young, having been developed since the 1990s, but are limited to high down payments, up to 30% of the property value. The Chinese market is also subject to risks of overheating due to high rates of house price appreciation. Japanese mortgages are characterized by low interest rates and long terms, up to 35 years. However, there is a significant dependence on monetary policy and its changes in Japan, which poses some risks in the long term. Germany has traditionally had one of the most stable mortgage markets in Europe. The advantages of German mortgages include the availability of long-term fixed-rate loans and strict regulation. Germany also heavily utilizes the rent-to-own system, which makes buying a home less popular than renting. In 2023, the volume of mortgage loans in the U.S. totaled about $11.3 trillion. The average mortgage rate ranged from 6% to 7% depending on loan terms. In 2024, there was still no expected decline in rates amid economic instability. In 2023, China's mortgage market size was at 10 trillion yuan, approximately 1.5 trillion. Mortgage rates are 4.5%, 5%, significantly lower than in the U.S. China continues to stimulate the market despite signs of slowing economic growth. However, China's real estate market has been in a protracted crisis since 2021, which has led to a drop in investor confidence in the sector. According to Bloomberg, despite early support measures from regulators, the housing market continued to deteriorate in 2024. The crisis affected all major players in the industry. In Japan, the mortgage market was estimated to be worth about $2 trillion in 2024. Mortgage rates remain among the lowest in the world at 0.5%, 1.5%, depending on the type of loan. Japan is the leader in mortgage rates in the region. Mortgage in the land of the rising sun is issued at 1.2% per annum, which is explained by high real estate prices and low inflation. According to statistics, the average cost of 1 square meter of housing in Japan is 5,000. In Germany, the volume of mortgage loans is 1.7 trillion euros, or about $1.8 trillion. Interest rates for mortgages in 2023 were 2%, 3%. In 2024, interest rates reached 3.5%, 4.0%, due to the extremely tight economic situation. Residential mortgage lending in Germany declined markedly in 2024, reaching its lowest quarterly value since 2014. Thus, total residential mortgage lending reached $46.7 billion in the second quarter of 2024. Deteriorating economic conditions, higher interest rates, and lack of affordable housing are among the factors leading to a decline in mortgage lending. Still, Germany is one of the largest mortgage lending markets in Europe. But back to the U.S. Originally, back in the 18th century, these were building societies or cooperatives. Today's Americans still had great-great-grandmothers paying mortgages. For them, it was a really massive and affordable option for buying a home. Later, loans on the security of housing migrated to continental Europe. It is true that in Europe there were many peculiarities in the mortgage. For example, in Sweden recently, it was possible to take a mortgage for 140 years, but later the authorities limited its terms to 105 years, which, of course, is an exception to the rule. Currently, the average mortgage term in all countries ranges from 20 to 30 years. This is due to the age limit of the borrower. It is necessary to have time to pay off the loan before retirement. Interest rates in countries with a developed mortgage system can vary from 1% to 30%. It strongly depends on where and by whom the mortgage is taken, as well as the amount of the down payment. Europe has some of the lowest mortgage interest rates in the world, however. Conditions differ within and outside the EU. In particular, in the UK, the rate on a housing loan ranges from 1.95% to 3.5% per annum. Moreover, such conditions apply to non-residents of the kingdom. The minimum mortgage amount is £350,000. The loan term varies from 3 to 20 years. The average mortgage rate in the EU countries is in the range from 1.5% to 5% per annum. The loan term in most countries of the region is from 5 to 30 years, and the minimum mortgage amount from €80,000 to €150,000. The lowest interest rate in Iceland, it starts at 1.5%. There, the borrower can take up to 80% of the value of the property on credit, and 20% he must make as a mandatory down payment. The maximum loan term is increased compared to the average requirements in the EU and reaches up to 40 years. Next comes Switzerland. Here the interest rate starts from 1.8%, but there is another advantage. The borrower has the right to borrow from the bank up to 90% of the value of the property. The mortgage term goes up to 50 years, and a lifetime mortgage is also possible. In Germany, the mortgage is available to both residents and non-citizens of the country. Its registration takes about a month, and the loan is issued for an average of 20 years. The interest rate depends on the amount of the loan and the term for which it is issued, on the credit rating, Schufa, of the borrower, his financial and marital status. For the previous 5 years, interest rates in Germany were 1.5%. But things have changed a lot in the last year, and now it is 4%. The down payment can be 10 to 20% of the cost of housing. Without a down payment to get a mortgage in the FRG is also possible, but in this case the borrower will set the interest rate higher. You can safely add 7% to 16% over the purchase price of real estate. This amount will go to taxes, notary, and realtor. Mortgage market in France is considered one of the most protected in the EU and the world. According to the local statistical gazette, in the summer of 2023, The annual mortgage rate there was 4.68% for fixed-rate loans with a term of 20 years. In Spain, citizens are given preferential treatment in terms of interest rates and creditworthiness. They can borrow up to 80% of the value of the property. But for foreigners who purchase real estate in this state, the conditions are stricter. They can borrow from 50% to 70% of the total amount. It is true that the housing market in Spain is still extremely attractive for non-residents. By the way, most often real estate there by British, Germans, and French. Fixed interest rate in Spain is from 3.45%, floating from 5.03%. In addition to the down payment will require other expenses, payment for property valuation and bank commission after the official closing of the transaction. All this will cost approximately 1,500 euros. There is a very interesting experience of mortgage lending in the United Arab Emirates. In the United Arab Emirates, the interest rate starts at 2.35%, but the size of the loan can vary greatly, ranging from 50% to 80% of the value of the property. In addition, getting a mortgage loan in the UAE is quite difficult. You need to collect an extended package of documents. The loan term cannot exceed 25 years. Nevertheless, the UAE has created very favorable conditions for the development of the construction industry, and investment in real estate is very profitable, as interest rates are quite low. As you know, 2006-2007 was a time when mortgage lending in the US was at its peak. However, amid skyrocketing real estate prices, banks began handing out loans to people with low credit scores, subprime mortgages. Banks, having inflated the bubble in the housing market, did not consider the risks, and in 2007, a wave of defaults began, which led to the collapse of the mortgage market and financial losses for many large banks. The financial crises spread around the world because subprime mortgages were wrapped in complex financial instruments, such as mortgage-backed bonds, MBS, which were actively bought by international investors. What are the prospects for mortgage as a banking product today? Its drawbacks and risks for banks and the borrower. Mortgage will continue to be an important instrument in the financial sector, but it faces a number of challenges for both borrowers and banks. For borrowers, high interest rates and strict down payment requirements make mortgages unaffordable for many families. In addition, constant changes in the economic situation can sharply increase interest rates, which jeopardizes the solvency of borrowers. The risks of debt default and possible volatility in the real estate market remain the main threats to banks providing mortgage loans. Deflation in the housing market, falling real estate prices and rising interest rates may lead to a decline in banks' asset quality. The outlook for mortgages in the coming years depends on the stability of the global economy and the development of new financial products. However, threats of a repeat of the 2008 crisis, given the current market trends and rising debt burden, are not excluded. In 2025, the global economy may face a new bubble in the real estate market, and risks for borrowers may increase amid rising interest rates and possible economic turmoil. Can we conclude from these statistics about which country's real estate market is overheated and may eventually lead to a bubble and a new mortgage crisis? Experts' opinions differ here. In the last 3 years in the EU and the US, rates have risen by 2 to 3%, which has a tangible impact on long-term mortgage loans. For example, China is still overcoming the consequences of the mortgage crisis in 2020, when, due to the pandemic, demand fell and the creditworthiness of construction companies was very high. And yet, a new mortgage crisis could be realized just in the U.S., caused by accelerating inflation and a doubling of mortgage rates. One of the indicators of the unhealthy state of the real estate market in the country is the level of mortgage arrears. It is usually compared to a state's GDP to analyze it. For example, in 2022, the ratio of mortgage portfolio to GDP in the EU countries was more than 40%, in Australia, almost 90%. Another indication that a crisis may arise in the mortgage market of a particular country is the ratio of household income to their expenditures on housing loan repayment. In most countries with a massive mortgage market, high ratios are characterized by China and Turkey. There, the average standard payment is equal to 3 average salaries. By comparison, in India it is about 1 average salary, in Europe it is about 60%, and in the US it is less than 40% of 1 average salary. It turns out that by this criterion in developed countries, the probability of a bubble is many times lower than in Asia or Latin America. In any case, the most indebted are countries with highly developed economies, where housing loans are most accessible to citizens. According to experts, the mortgage crisis of 2008 started with the USA, and it is not excluded that new global challenges will follow from the USA. After all, if a mortgage bubble bursts in one of the developed countries in the world, then, like a domino effect, other countries will follow, because the total delinquency on all types of loans is growing every month.